Welcome back. Next week, marking the busiest of this earnings season, 1/5 of the S&P 500 set to report on their recent quarters. Let's bring in Capital Wealth Planning's Kevin Simpson with how he is positioning. Nice to see you again.
Hey, Scott.
Let's run through some stocks here. I see that you bought Apple again when it reached down to 183, 185. It's been back towards the march towards 200.
Yeah, for those of you following at home, what do you mean you bought back Apple? Because, Scott, you and I talk about it all the time, but we had the position called away around Thanksgiving, effectively at 187.5. The rest of the shares we sold at 192. And of course, as Murphy's Law would have it, it continued to move up to about 200. Now, I'm not crying over spilled milk. We bought Broadcom. I think it's up 30% since there. But Apple specifically, it backed off 10%, got into the low 180s over the last week and a half, 2 weeks, and we started reinitiating that position. I still think it's a little stretched. I think the multiple's a little bit higher. Maybe we're over our skis. We heard earnings coming out next week. Scott, I expect them to be tepid at best. But Apple's a unique stock, and when I have the opportunity to get back into it more cheaply, less expensively, we absolutely wanted to reinitiate that position.
You sold out of SLB, but you're bullish on energy. Tell us.
Yeah, we got stopped out of it. I mean, I can't stand when that happens, but we follow a rules-based strategy. And as much as we like energy, and we own Chevron, we own ConocoPhillips. Chevron, by the way, had pretty lousy earnings last quarter, so we're going to be watching that very closely. But on a pure price action play, SLB came down and we got stopped out. I think very, very highly of the company. But if the price action isn't there, we've got to recognize and acknowledge our rules-based process. Still owning Chevron, still owning ConocoPhillips gives us good exposure to energy. And I'm not suggesting that we're wrong on that call. I just think maybe we were a little bit early.
You bought sell to open calls on Microsoft and Cisco. Explain what that is.
Well, we wrote the calls because we have earnings coming out. And volatility has been so low for the past few years, it's been difficult for us to write options. But when you get into earnings season, you can have some fun with it, because within individual names, you'll see heightened vol going into the earnings, especially with tech names. So if you look at this trade on a 425, we don't expect that to get called away. You know, earnings should be good next week, and you never know what's going to happen. But it allows us to supplement the dividend. And if for some reason Microsoft disappoints, which I'm not expecting, it gives you a little bit of a buffer to the drawdown on the downside. And that's how we look at covered calls, not as a means of generating cash flow just for the sake of cash flow, Scott, but for helping to buffer our portfolio and essentially over time to smooth out the ride.
Jeremy Siegel was with me earlier and suggested, since we're on the topic of mega caps, that you could get zero out of the mega caps this year and still have a really good market year of maybe 8 to 10% more from here. You buy that?
Well, from the professor's mouth to God's ears, because as a value manager and a dividend growth manager, I mean, it's incredibly challenging. And I speak on this firsthand when your entire asset class or your entire category is basically catatonic in a closet for 2 years, and you're watching a handful of tech stocks go up. So it would be great if he's right. Here's why I don't think he is, because if we see a Fed that's decreasing their interest rate policy, meaning if rates are going down, doesn't matter if it starts in March or it starts in September, if rates are coming down, I think it's constructive for stocks across the board. And I tend to think that people will pay up for growth so that it wouldn't be a growth versus value trade or a tech versus non-tech. But his point about PE ratios, I mean, that really, really resonates with me. So maybe we don't need to see zero growth there. We can see modest growth. But the broadening and the breadth of the market that we started to see at the end of October, that happened to continue in November, December, and here in January, he and I are totally on the same page with that moving forward for 2024.